look, if there's one takeaway from this earnings season, it's that we're completely hostage to the insanely strong dollar. So many companies have reported numbers that would have been fantastic. They just have been weighed down by an unfavorable exchange rate. I talked about them even at the top of the show. I know a strong currency sounds like a good thing, and it is if you're buying from overseas. But it is the kiss of death for any American company that does business overseas, both because it makes their goods more expensive and because the exchange rate means foreign earnings translate into far fewer greenbacks when the dollar shoots up like this. Now, thanks to persistent inflation worldwide, investors are parking their money in U.S. Treasuries, hoping to wait out the turmoil. To do that, they need to exchange their currencies for dollars first, which is why the dollar keeps getting stronger. That's why tonight we're going off the charts with the help of Carley Garner, a brilliant technician who's the co-founder of DeCarley Trading and the author of Higher Probability of Commodity Trading, which I recommend to you, in order to get a better read on what's happening with our currency. And I love this piece. Garner points out that whenever you speculate in stocks or bonds or commodities, you're indirectly trading in U.S. dollars. For example, the U.S. dollar index, which measures the greenback against a basket of foreign currencies, settles in the opposite direction of the major averages, roughly 90% of the time. That's incredible. Same goes for 10-year treasuries. That's the treasury futures. If anything, that correlation is just too extreme. Garner thinks it's likely comes down to algorithmic trading programs, overzealous hedging, and momentum traders, not, and this is what's so important for you at home, the fundamentals. But for whatever reason, we can't deny that the dollar's in the driver's seat. Just take a look at this intraday chart showing the dollar index futures in green and the E-mini S&P 500 futures in red. Each price bar represents 6 hours of action. Garner points out that they're practically mirror images of each other. So, S&P goes down, dollar goes up. This is really important. This is it. Look at this. Every time. Ever since July, they've had almost an absurdly strong negative correlation. Stocks rallied in mid-August, then the dollar started picking up and stocks collapsed. So you can see it over and over. Every time the dollar picks up steam, the S&P gets slammed. Every time the dollar starts pulling back, like last week, the S&P starts showing signs of life. And look, you can see the exact kind of correlation between the dollar index futures and the copper futures. The correlation is so strong, it's like synchronized swimmers. Of course, there should be some relationship between copper and the dollar. After all, copper's priced in dollars. But lately, Garner thinks it is. Come on, admit it. You have to. Sometimes the charts are incredible, aren't they? Garner says that copper's behaving like the greenback, and it really is the only factor that matters. All right, now let's get to the big daddy, bonds. Check out the daily chart of the benchmark 10-year Treasury note in purple versus the dollar in green. When the dollar surged in August, it created a one-direction environment in treasuries, where prices go lower and yields go lower. Garner notes that only the brief pause in the dollar rally last month, and that's right here, see the green, that pause gave the 10-year some relief. But that turned out to be a head fake or temporary, depending upon how you feel about things. So if the dollar keeps running, she thinks we're in for a world of pain. But can it keep running? That's the point of this piece. According to Bloomberg, the most overcrowded trade out there right now are people going long the U.S. dollar and long crude oil. Whether that's about speculation or hedging, Garner says both oil and the dollar have been perpetually overcrowded ever since Russia invaded Ukraine. But one is not like the other. Oil peaked at $130 a barrel over the summer and is now pulled back to the mid-80s. Something, by the way, Garner called in advance on this show. On this show, you got that call to sell the oil. She was adamant the Ukrainian spike in crude would be temporary, when many others felt it was just a way station to go even higher. The dollar, on the other hand, just keeps chugging. It's the one asset yet to revert to the mean. Everything else, stocks, commodities, bonds, have all swung back this year. As Garner sees it, the greenback is the last holdout, and she doesn't think it will last. So check out the weekly chart of the dollar index going back 5 years. Garner points out that historically the dollar's been known to make dramatic tops. Look at that blow-off, will you? The last 3 peaks follow a trend line that dates back to 2017, and the dollar's just under that trend line right now. It's the ceiling of resistance, okay? Garner's been watching this level at this 113.40 as a potential area of what would be a reversal. Thus far, the dollar hasn't been able to close above that level. Right here, this is it. As long as it can't break through that ceiling, Garner thinks the dollar will become increasingly susceptible to gravity. In other words, she expected to suffer the same fate as every other asset class this year, mean reversion to a more natural level, one that's a lot lower. Currently, the dollar index is 112. She would be surprised to see it 105 on the downside, which would represent the weekly trend line, excluding a spike in March of 2020 when COVID first hit. Longer term, she could see the dollar's index sinking all the way back to 97, where it was trading before Russia invaded Ukraine in February. That would be spectacular for stocks. At the same time, Garner sees a habitual bearish divergence on the relative strength index, or RSI, down at the bottom. This is really important. This is an important momentum oscillator that helps identify when price moves have gotten overextended. When the RSI reaches an extreme height, as it has right now, then that makes lower highs as the underlying asset keeps climbing. That's called a divergence, all right? Now, when it's what we're looking at with the dollar index. More often than not, Garner says, this is a sign that momentum is waning. When the RSI gets overbought like this and starts to falter, there's a good chance that the underlying asset is going to get crushed. So we have to watch the RSI too. For example, the RSI for natural gas looked like this for a while. For the nat gas futures, swiftly lost 40% of their value. Again, a move called by Garner. Why does this matter? Because Garner sees that even if we have high inflation and high interest rates and political turmoil, if the dollar can start going lower, all sorts of assets should be able to gain value. The big winners would be internationally oriented companies like I talk about all the time, including Procter & Gamble and Johnson & Johnson and Treasuries. But it would also save us a bundle on commodities. Here's the bottom line. And commodities are really jacking up the price of things. The strong dollar has become an albatross around the neck of an already beaten down market. But now the charts, at last, as interpreted by Carley Garner, suggest the dollar could be peaking. I hope she's right, because a weaker dollar will be incredibly strong for almost every single stock. I say we take calls. Let's go to Bill in Virginia. Bill.
Yes, sir. Mr. Cramer, how are you doing today? Bill in Virginia.
Jimmy Chill's doing well. What are you up to?
Trying to make some money here with this down and the turn in the market and the federal interest rate increases. Just wondering about SoFi for a long-term.
I think SoFi's bottoming. I think Anthony Noto, this is how it starts. It's at 5. Now, it was all the way up, and we got the SPAC money out. I did not like that. But I think SoFi, which is a very interesting bank, really building itself out, is at the right level to buy. Now we're going to Tyler in California. Tyler.
Big Booyah from California. How you doing, Jim?
Jim's doing well. How about you?
I'm doing good. Thank you for asking. So I'll make it quick. With lots of insiders and institutional banks buying up shares, and the stock beating the last 4 earnings, it has a 4.38% dividend yield. I would like to know what you think of, especially with the cost of food going up, how this affects a stock like KHC.
Okay, Kraft Heinz is a terrible company, but its stock reflects an even more horrible company. So the stock is too cheap versus what is a not great company. And you know what? Sometimes we can make money like that. You never know, but I think you can with that one. All right, the dollar strength is hitting the market hard, including some of my favorites like Procter, J&J, but the chart suggests it could be peaking, and a weaker dollar would be a gigantic positive for stocks, for companies that have to buy commodities. It would really be just great for the translation. Oh, man, she's right. This market's going to soar. Much more money ahead. Could Iron Mountain bring some strong gains to your portfolio? I'm taking a close look at the stock. Give you my take. Then, should watching the early morning futures be a part of your investing strategy? Or could it skew you in the wrong direction? I'm digging into the action of the last 24 hours and giving you the best way to navigate the early morning movements. And all your calls, rapid fire, tonight's edition of the Lightning Round. So stay with Cramer.
Shepard Smith here. Thanks for watching CNBC on YouTube.